Good talk. Thank you. Up next, we have Craig Fuller, the CEO of TransVix.
Good evening, everybody. I'm happy to be here. I'm been here in Dallas-Fort Worth for the last 2 years. My background is I have built 2 different companies focused on transportation technology, and one we grew to 144 million and $68 million of EBITDA within about 2 years, and the other was a payment fuel card, fleet card company that we sold to U.S. Bank a couple years ago. So what we are building is a futures exchange, a derivatives exchange based on transportation spot capacity. And we'll talk about how that works. And so if you think about commodities, if you guys have seen the show or the movie with Eddie Murphy where they go up and they are trading the Chicago Board of Trade, this is essentially the same concept in terms of commodities, is we are attempting to convert transportation pricing and transportation capacity into a tradable commodity. It seems a little strange that you could actually do it something that doesn't have physical delivery. It's perishable in nature. But this has been done in the maritime space. About $200 billion a year are traded in derivatives based on maritime spot capacity. And we believe that you could do that in the trucking market as well. So that's essentially what we are aiming to do, is basically create an interchangeable, tradable commodity in terms of pricing for trucking spot capacity. And so this is a market where, in terms of our team, we've assembled folks from the trading community, and we've assembled folks from the trucking industry to really solve this problem about volatility and pricing. We just raised our Series A, or seed, depends on, thank you, depends on how you classify it. So 2 months ago, we raised $2 million from Hunt Technology Ventures. It was essentially a spreadsheet or a PowerPoint presentation when we raised it. So we actually just had a team of people that were qualified individuals. And we believe that we can build a multi-billion-dollar company by creating an entire new market to help solve the margin problem and pricing volatility problem that exists in trucking. There have been over $1 billion in venture capital funded in the transportation trucking industry specifically in the last 2 years. And there's all this idea of Uberization of trucking. If you think about Uber basically what they've done is they've optimized the personal transportation market, but they've also essentially created this whole set of capacity that didn't exist. You can't do that in trucking. There's not like a truck driver or a guy who says, hey, I have this 53-foot trailer behind my house and I'm going to drive for the weekend. That didn't exist. So you can't Uberize the industry, and trucking transactions are not, for the most part, interacted on a mobile phone. So in order to really solve the price volatility and to create a more stable marketplace, you've got to create a situation where companies can offset their risk and volatility by selling futures, and that's essentially what we're going to be doing. So I gave a short introduction of myself, but I think more important, the team behind me. I am literally, consistently, the dumbest guy in the room with our management team, and that is pretty awesome, the team that we've assembled. So one of our executives was number 2 player at a company called C.H. Robinson, a $15 billion logistics company. Went from 0 to 15 billion the time that he was there. Global head of derivatives for Morgan Stanley is part of our team. The number 1 trucking company, the EVP of sales and marketing. And so what we've done is we've assembled folks that can answer the question of how do you create a tradable commodity of something that's perishable and synthetic, but also how do you solve this problem from an industry standard up? So that's essentially what we're aiming to do. If you look at the market opportunity, trucking in the United States is $700 billion. It's $2 trillion globally. Represents 12% of global GDP. And yet, as a commodity, it's not traded. But it is priced like a commodity. Trucking companies are subject to the same sets of supply and demand fluctuations that any other commodity is. And it is an opportunity for us to create a tradable commodity. And we believe the value in terms of total volume that can be traded is about $2.8 trillion. So it's a major, major opportunity. We derive that information looking at the size of the maritime market that exists over in London. And so basically the problem that we're solving is giving structure and predictability in transactional relationships and allowing trucking companies and market participants to hedge and protect the positions against volatility. What happens in the market is shippers go out and there's, Walmart spent $10 billion in trucking. And what happens is they try to lock in prices and prices fluctuate, and as the prices go down, trucking. So I guess I'm done.
Okay, question.
Can you help me understand? I'm trying to understand what you're actually doing. So is the problem, I don't understand the volatility piece, like what's going up and down? Like what pricing is it the actual space? And I'm assuming you're talking about the space volatility. I'm just trying to understand the problem a little better because I'm not getting it right now.
It's price per rate per mile. So we're not dealing, you think about when you buy a truckload, which is 95% of the trucking, we're not talking about FedEx and UPS shipping a box. We're talking about 53-foot trailers. You ship a feather or 45,000 pounds of steel, you're going to pay a rate per mile. So that rate per mile, it fluctuates on about a 40% band on a yearly basis. And the problem is, if you own that truck, your costs don't change. You got to pay the driver, you got to pay the fuel, and you got to pay the truck payment, and your costs don't change, but your margin entirely does based on fluctuations. And so as the market softens, pricing goes down, and yet you have no way to offset that. You can hedge your fuel, but you can't hedge your pricing. And so your entire margin is based on that. It's essentially what it is.
My question builds off that one, and you started to get into this when you started talking about Walmart. But can you basically use Walmart or another big company that we would understand from a trucking standpoint and say the same thing, but in terms that are company-based and why a company would want to go down this route, so I could better wrap my head around the problem that you're trying to solve?
So average trucking rate's $1.50 per mile. If you're a trucking company and pricing collapses because the economy collapses, as it's right now happening, then pricing's off 40% in 2 years. So what's happened is that price went from $1.50 to say $1.20. You're losing 30 cents in revenue, top line, but your costs don't fix if you're a trucking company. You sold capacity to Walmart. So you're subject to the price volatility. So with a future, you can offset it because what you're doing is you're selling the right of that transaction in the future. Does that make sense? Sorry.
If that's what's happening with the company as of right now, right? You have those future contracts that you're trying to create structure and predictability around. As Walmart, are you buying the structure and predictability? You're buying those contracts so that the trucking company has that revenue that they're able to say, okay, we know that we're doing Walmart in 1 year from now, 2 years from now?
There's two counterparties. There's a buyer and seller. Somebody's selling, somebody's buying. It's a zero-sum game. You have stock, you buy or sell it. Somebody bought that transaction. When a stock transaction happens, somebody bought that stock and somebody sold it. So Walmart is selling a future and somebody's offsetting. Walmart's betting that the price goes down and the trucking company bets the price goes up. That's what they're betting.
So what type of platform do you offer and who are the users of that platform? Like what is your
trucking participants and large global financial firms like Goldman Sachs and Morgan Stanley.
And is it like, how do they use your product? Is it like a website or app?
It's a website. It's all cloud-based.
It's all cloud-based.
It's an exchange. So it's a regulated exchange by the CFTC, like SEC.
So I was wondering who the market maker is going to be for this particular thing. Is there? Oh no, it's 1 minute and 34 seconds. Sorry. The market maker in the exchange. So is it going to be directly participants in the trucking market playing against each other, or are you guys going to step in to try to fill the other side of some position if somebody wants to take it?
We're strictly an exchange, so we do not have a position in the market, but we facilitate parties with it.
So are you going to have these on different hubs like Chicago, Houston, Atlanta? So I own 50 trucks. So the market goes down, capacity goes up. So in the spread that I'm going to pay for this going to outweigh the cost of it going down?
Well,
Because I only have a little teeny margin anyway.
you do have a teeny margin. That's what we can help with because in the actual physical market that you're in right now, the tender market, you have no way to offset that price. But in what you would do is you would be subject to the same supply and demand fluctuations of price that happen in real market, the market you're talking about today, but you offset that with a future. So the delta between the two should net you out to zero. So you could lose in the actual tender market, but you're going to make 30 to 40 cents a mile in the actual futures market. Does that make sense? It's all about offsetting risk.
Okay, so clearly we didn't get to see the whole
Sorry,
story, and there's a lot of
It's
confusion.
my
so,
first.
So what can we do for you as sort of just general? I'm not a trader, but was there anything the community here can do for you?
We want to connect to the community, connect to other individuals that are building interesting things. We want to financially help the community if we can, hire